Welcome to Life, Listings, and Everything Real Estate. I'm your host, Amber Jamanka, your favorite realtor here in Cambridge, Somerville, working in the whole greater Boston area. Today, I have a special guest here to talk to us about taxes and specifically how to maximize deductions as real estate agents and keep more of your money. Don't worry about taking notes. We have the whole thing summarized for you in a PDF, so just check the show notes below about how to get a copy for that. Thanks for joining us.
Hey friends, it's your girl Amber, your favorite realtor, and today I have a special guest, my new friend, Catherine, aka Cat Lane, and she is going to talk to us about our favorite subject, taxes. Just kidding, but our favorite subject is saving money, and that's what we're going to talk about today, paying less taxes. Kat is the founder and owner of Beyond the Books Accounting. She is an accountant and an enrolled agent with the IRS, and you could tell us what that is. And she lives in New Hampshire, but can provide services throughout the whole country. Welcome.
Thank you. Thank you for having me, Amber. So, as Amber said, I'm an enrolled agent with the IRS. So, essentially, what that means is I can prepare your taxes, I can sign your taxes, and I can represent you in front of the IRS. Super fun. And what I do is I work mostly with small businesses to not only help them throughout the year with their bookkeeping, but also to, help them with their taxes. And one of the biggest portions and why I call myself Beyond the Books is I like to have that education with my clients, and so that they don't just get their financial statements or they don't just get their taxes. They're actually kind of understanding what everything means, and how to utilize what they're learning throughout the year.
Awesome. It's definitely easier when you can plan throughout the year instead of having it be putting out fires on April 15th. So,
Yeah. Be your tax accountant's friend and prepare throughout the year instead of like handing them a shoebox on April 14th, because we're not going to get it done. We just cannot get it done in a day.
yeah, awesome. Super important. And I think as real estate agents, we've all learned that the hard way, and we are notoriously bad at saving money for taxes. So you're here to help us make a plan. And we are recording this at the end of January, purposefully recording this before most people will have done their taxes. So this episode is going to be about how to maximize deductions and maybe some deductions that people haven't even thought of, and then just reduce the amount of taxes owed. And so, yeah, take it away. What can we do to pay less?
Organize, organize, organize. So most of the times, and I joke about the shoebox, but I really have received a shoebox of receipts
Oh,
before.
no.
It was awful. I did not take that client back the next year. But essentially, what happens is, you get to the end of the year and you're like, oh my goodness, what do I do? What can I deduct? What can't I deduct? But really, if you keep track of everything throughout the year, then this portion of your life is not as stressful. And that's the problem is, we as small business owners put off things because we're so busy working on our business, but we forget that all of these things are going to make our lives easier and our tax accountants' lives easier. But really, the main thing that I've realized with my real estate clients, my real estate agent clients, is that they forget what they can deduct, and or they don't know, or they were never informed, or that's why people like me exist, is because we understand what the IRS is trying to say in that really large tax code. And then on top of that, things change every year. So having a nice interpreter, if you will, really helps out. So even if it is just pen and paper, keeping that listing of what you've done is very helpful. Keeping those receipts, keeping a spreadsheet, My most favorite accounting software is Xero, Xero. It's very easy to understand. I always find QuickBooks very hard for non-accountants to understand. So, there are everything from, pen and paper all the way up through an actual accounting software. But the expenses that I kind of wanted to talk more deeply about today are things that we might forget about. So, you guys use your cell phones a lot. You are constantly on the phone with clients, with other agents, with brokerages, with everybody. And a lot of times it's your personal cell phone number. And so what the IRS says for expenses is that they need to be reasonable and or I'm sorry, not reasonable, ordinary and necessary. So you guys need it is ordinary and necessary for a real estate agent, most small business owners in general, to need a cell phone to conduct their business. But what percentage is reasonable? So for me, I've actually kind of went around that. I have two different SIM cards on one cell phone, so I can claim an entire line for my business. And then for my personal, obviously that's a personal expense. But I mean, if you're working 8 hours a day and you're sleeping 8 hours a day, that leaves 8 hours a day for personal time. So, a third of your business or a half of your business cell phone is absolutely reasonable for an agent to classify.
Yeah,
Home office.
especially because we're not even just making calls nowadays. I have my brokerage, we have an app where we, can file all our paperwork right from our phone, research properties. I pull up the MLS on my phone. I actually, when I'm with clients, I don't use the computer almost at all anymore. So it's pretty crazy.
Well, yeah, and I mean that brings up kind of the next thing is apps. I mean, how many apps do you guys have to download to conduct your business? A ton, and not all of them are free. So, I mean, all of that, those small costs that you don't think about. And, it's what about your Microsoft Office? What about your Adobe subscription? All DocuSign or anything, Panda Doc or any of those, signature types of things. Sometimes your agencies, will provide that for you. Other times you guys have to pay for that out of pocket. And I mean, all of those add up. And you'd be surprised at the end of the year, how many of these little tiny charges really add up.
Yeah,
The
and that's one of my, I guess, pro tips or something that I do to make my life easier and my accountant when I went to file. And I am not the most organized person, but when she told me that my paperwork, that my files looked better than most, I realized how bad other people must be because I thought I was scrambling so much. But I almost never pay cash for anything. I try to put everything on my card, even if it's that daily cup of coffee for $5. But like you said, those little expenses add up. And, I don't keep track of it very well throughout the year, but I know there's an electronic record of it and that I can go back retroactively and organize it and categorize everything.
Absolutely. And that's, the amount of meals that you can charge as a real estate agent, I think is a one of the biggest categories that you guys forget about throughout the year. So when I just recently purchased my house, and my agent, we met at a coffee shop to begin
Congrats.
with.
Congrats.
Thank
Congrats.
you.
Yeah, totally. It's so funny because, I know that, coffee and food and eating out, it has to be business related, but everything is business related. It's like when you're a real estate agent, every conversation you have is going to come back to real estate at some point. And, our whole job is keeping up those relationships and those connections with people. So even if you're not specifically talking about real estate, but that having that connection, that contact with somebody that's even your friend, but they're going to be the one referring you a client. So, I mean, it
Yeah, I mean,
really
could every meal be classified as business? No. Most of
has
them,
to be
yes. I mean,
reasonable, right? Ordinary and reasonable.
ordinary and necessary, and that is
Yeah.
very ordinary and necessary for you guys. And so the thing with meals is at the end, so you need to keep track of 100% of your meal expense at the end. The tax magic on that for 2024 and now 2025, unless they change it again, which who knows, is that 50% of that meal is actually deductible. So let's say you spend $50, $25 of that is actually what's deductible at the end of the year. But keep track of all of it because you want your tax accountant to do that math for you, not because you guys can't split things in two, but because we actually have to enter in most of the accounting software, the tax software, we actually enter in that whole amount, and that's what gets taken out. But the other thing with meals is the extravagance of it. So if you're buying, a cup of coffee, a $5 cup of coffee with your client, that's not extravagant. If you're taking every client out to a $400 steak, okay, that's going to be a problem. But I mean, it's the ordinary, necessary, reasonable. If you're taking a specific client out 30 times in the same year, they're a little too picky. Like they maybe should be looking at a different region or something to buy their house because that's a lot. So I feel
Hey,
like
I've seen it. I've seen it.
oh, I know. I remember, oh God, it's been probably, 10 or 15 years ago, but when I was still working in corporate, I had a girl like, oh yeah, we just looked at our 130th house. I was like, your agent needs a raise. Like, that's terrible.
Hopefully they bought something eventually with their
They
poor
did.
age.
It was great, but so bad. But I mean, it's those items that you just kind of need to keep track of. So I think meals is a really good time to kind of segue over to what documentation do you really need. Yes, your credit card statements can suffice. However, the other records you need to keep specifically for meals are who you had the meal with, kind of what the topic was. So if it was, potential client, that's enough, but you need to have who it was, the date, the business reason, and those are the items you need to keep. For meals over $75, that documentation requirement from the IRS goes up a step further and says you have to have that itemized copy. So not the one that says, "Hey, here's my signature and the amount of tip I left," but it's the one that says this person had a hamburger, this person had a chicken sandwich, this person had, that's the kind of itemized receipt that they're referring to. So what I typically tell my clients to do is I, as a tax preparer, do not care. But what I do need to see at some point is that you realize that you need to keep that documentation for 6 years. On the seventh year, toss it. And digital copies are originals. So let's say you take a photo of it and you just throw it in a photo folder. That's sufficient. That's absolutely okay. But just, I like to have more than less. So I just tell my clients, keep everything. Even if you don't think we're going to need it, just hang on to it.
Well, that you just gave me a really great idea because I am not great at keeping the paper, but I can take a picture of it and then just create a folder on my phone for all of those. Unless there's an app that you recommend for
There
doing
are
all of that together.
so many great apps for that. So I
Mhm.
talked about the accounting software Zero earlier.
So that
Zero,
includes like you'd be able to take a photograph and
yeah.
include
So
that.
it's a sister company. It's a company that they purchased called HubDoc. There's also something that is called Dext. It was formerly called Receipt Bank. Tons of different apps. But the reason why I tend to go back to HubDoc is because with the Zero subscription, HubDoc is free.
Gotcha.
So that's kind of what
We like free.
again, the saving money is the whole tip, right? So that HubDoc is really nice because it categorizes, it uses AI and it categorizes it by, as much as it can read the receipt. There's obviously things that it's not going to be able to, and you have to kind of hand code that in. But let's say you want to know how much you spent at Home Depot to, stage a client's house. You're going to need to know, you can pull up that Home Depot folder within HubDoc and it says, here's what you spent. Then you can drill down to that actual physical document. So, I mean, and that's it might be overkill for some people, but I just really like it because you have that. You know the date, you know what it was for. And a lot of times, like, I just physically hand write on my receipt what it's for. Then I take the picture, then I move on. So like I was at a restaurant yesterday and I wrote on top of it what it was for. obviously it has the date, it has the vendor, it has, what I purchased. And I took a picture and I just left it there. I didn't need to take it with me because I already had it captured. And the it was cute. The waitress is like, "Do you need to take this with you?" And I was like, "I got it. It's already in here. I got it. I don't need it."
Awesome. So speaking of apps, I know one of the things you had mentioned was mileage as something that
Yes.
that agents might not be thinking to really track and deduct.
So mileage and gas and car washes and all of the things related to vehicles, there is a big black hole in research on how agents should do this or how small business owners in general should do this. And the way that the IRS says is you can either track mileage or actual expenses. So obviously, we all use our cars for personal uses as well. So when they talk about actual expenses, they're talking about how many miles did you spend in business versus how many miles did you spend in personal for that calendar year. And then you take that percentage of how many oil changes, how many car washes, how many, tire rotations, and you see how it's getting more complicated? It's
Yeah, and
and
why did it not even occur to me to deduct car washes? Not that I do that often, but maybe now I will, now that I know it's
well,
deductible.
but the complication of that is offset. So you can
Um,
either do all of those things and keep track and keep the receipts and do all that, or you could simply just
or
track your mileage.
mileage.
So
Okay,
for
gotcha. That's what I
2020,
do.
exactly. So
Mhm.
for 2024, it's 67 cents a mile. For 2025, it's going to be 70 cents a mile. So if you think about it, let's say our car gets 20 miles per gallon. You see where I'm going at this? And you're charging 70 cents per mile. You're at $14. Well, gas does not cost $14 a gallon. So those are things that we're starting to kind of look at and think, okay, it's time versus reward. So yes, let's say
Mhm.
my car breaks down and I have to spend an extraordinary amount this year. Okay, my actual expenses might be higher this year, but it's still just as simple to claim the mileage. So I'm
What
at
about
67 cents or 70 cents a mile, depending on, which year we're talking about. But it's so much easier, especially with the use of apps like Mile IQ, which is what I prefer. And you can just swipe. This is a personal drive. This is a business drive. This is a personal drive. And that makes it so much easier.
that is a great tip. And then I was going to ask, what about the difference between leasing a car and financing a car? Say your monthly payment was the same. Would there be any benefit to either?
Nope, not at all. So I mean, because it's the usage of the vehicle, unless, and this is kind of where it gets more complicated. Let's say you own a business and you employ other people and the business owns the vehicle, then you can claim that interest expense as a deduction. However, in your line of work especially, it's mostly personal vehicles that are used for business. So they're the actual financing or the leasing of the vehicle doesn't come into play here.
Okay. Good to know. Good to know. Any other areas that you think agents just miss?
So we talked about meals, we talked about mileage, software, home office.
Hmm.
Very similar to mileage, the IRS gave an easy button. So the easy button for home office expenses is $5 per square foot up to 300 square feet. So the caveat with home office expenses is so many of us just, have a space that, is in your kitchen, or Amber, I know you go to coffee shops a lot, I think, and work. And so the home office expense needs to be used regularly and exclusively for business. So let's say you have a home office that's inside of your guest room. That doesn't count. It doesn't work. So it needs to be its own space. Now, that doesn't mean like it can't be attached to the house. So, my office, I have a hallway that runs through it, on the side of it. So, what I do is I just claim my area rug, which is 11 by 14. It works just fine. But I don't use that specific space for anything else. So
Mm.
yes, it has a hallway through it that you have to use to go upstairs, but the rest of the room is used regularly exclusively for business.
Right. All right.
Mhm. Let's
What
see.
about two areas that I'm interested about are medical. What is the kind of best way to, should we prepay for anything? What is it called? The HSA? Is that?
Yeah,
Yeah.
health savings account. Um,
Yeah. So should we do that, or can we just do it retroactively? And then also for investing and specifically retirement, and how does that play in?
So there are specific health accounts that you can actually, do it's pre-tax money. So it's before tax. So let's say you were an actual employee that has a W-2, that would be taken out before your taxes are withheld. So for individuals that own their businesses, for people like you guys, the real estate agents, typically what happens there is you have to save back your taxes because you're the one that has to remit them. Your employer is you don't withhold those. So what happens with that is things like a health savings account are absolutely great to look into because that's a tax savings. But let's say you didn't contribute, but you have some extra money right now. You can retroactively go back and put in that money. Same with retirement accounts, especially related to IRAs. You have until April 15th of the next year to put in your money from the previous year. So these are all ways, I mean, everybody wants to retire someday. We don't want to work forever. So having these tax savings to incentivize you for saving for retirement is great. So what I would do in this case is get a hold of a financial planner and say, hey, these are the things that I would really like to do. And they can help with things like health savings accounts. They can help with SEP IRAs, simple IRAs, 401ks, single member for. They know all the things. I just know after you do that, what we can do for deductions. So, but I mean, utilize everything you can for those deductions. It's really helpful.
Just to translate, if we are filing our taxes and it's 2025 and we want to reduce the amount that we're going to pay for 2024, it's not too late. And we can go ahead and set up that retirement account and reduce the amount that we are paying for last year. So that is
Correct.
really great to know.
Yes.
Great to
Yeah.
know. Okay, another question that I have is, for a lot of us in real estate, some of us work for brokerages that provide us with passive income in stock benefits and revenue share, or some companies do profit sharing. But I know that at my brokerage, there are people making literally hundreds of thousands of dollars just in revenue share. So, can you talk a little bit about the difference of how that might be looked at in income commission versus passive income, and yeah, how that be treated differently?
So, a lot of different angles here that are happening. So, the first is that, again, one of my favorite phrases from the IRS is all income is taxable, except where otherwise noted. So, those otherwise noted, let's just ignore those because there aren't really any. So, all income is taxable. So, we just need to know at what point, at what level that income is taxable. So, let's talk about stocks for a second. Let's say your brokerage gives you, $1,000 worth of stock. Well, that $1,000 is income, right? Kind of. So you
It's
actually
just sitting
don't,
there. I can't
I
spend
know,
it.
exactly. So you actually don't have to pay the capital gains tax. So because stocks typically, and we would like them to appreciate in value, you don't have to pay that gain until you sell it. So it sits there and it hopefully accrues cash and the dividends, the interest. If you get that money back, you have to pay the income tax on that. But that gain is not taxable until you sell it, and that all bases on what the the price of the stock was when you acquired it versus when you're selling it. If you hold that stock longer than 12 months, it's called a long-term capital gain. And that long-term capital gain is taxed at a lesser percentage than the short-term under 12 months capital gain. We want to keep that as long as possible so that that tax liability starts. There are also a lot of different ways, and this gets pretty complicated. You can cash out that stock, you can do it for a lesser price, you can split the stock, you can blah blah blah. That's a whole mess. Talk to somebody like me or a financial planner to understand, exactly what your specific needs are and what you're going to do with that income and how you're going to sell it and, do all that. Financial planners are so much more well-versed on how to, turn that into something different. I don't know any of that. I just know, again, this is what happened and I can historically record this. So let's kind of shift gears to not the commission, but you called it, what did you call it, Amber?
Revenue share or passive
Right.
income. Mm-hmm.
So you're probably going to get one of those handy dandy 1099s about this time every year. So end of January, beginning of February, you'll start recording that 1099 income. So they have to report that to the IRS if they've given you over $600, and even if they don't give you a 1099, it's still reportable. You have to record it. You have to tell the IRS you made that money. So that's a misconception. Just because it's under $600 does not mean you don't have to record it. So what that ends up doing is you owe income tax on that income. All income
So
is
it's treated
taxable.
the same.
It is
Yeah.
treated
So it's
the
basically
exact same.
just treated the same, which means it's also still eligible for deductions.
Correct.
The same business
All
deductions
those,
that you
yep, all those business deductions we talked about, use them.
Mm-hmm. Awesome.
Which also, I'm kind of thinking about this, things that you might forget about as real estate agents. How many times do you guys write notes on paper? You have to buy those
all the
notebooks.
time. Yes.
And how many times do you
one
forget
right here.
that it's all the things that you use every day that you forget about. What about your pens? Like, you had to buy the pen, right? So make sure nickel and dime it, just everything that you use for business, put it down. And your tax accountant will tell you, no, that's a little too out there. We're not going to do that one. But you just got to think about everything.
What about, this is kind of random, but I do a lot of social media, and for that I might buy, makeup or clothing that is not necessarily for showing a property, but it's still, to me, it's still work, because the only reason I'm posting these pictures on social media is to improve my visibility and get more clients. So how would you treat any of those things? Jewelry, makeup, clothing?
The IRS closed that loop.
So no, we're not allowed to.
No. So my specific
What about
example.
a photo shoot? A photo shoot wearing that clothing. Can I deduct the photo shoot?
So yeah, the actual act of the photo shoot that you're paying the photographer, for sure. Like, or if you're like renting clothing from them. Like, I know some photographers have like, clothing rental. If you're renting it for the photo shoot, sure. But the example that I like to give, and this is when I was taking my exams, this is one of the examples that stuck with me, was hand models cannot deduct manicures. So you would think, okay, it's a hand model. They're obviously, the manicure is for the photos or but it's because it's used outside of business too. So clothing can be used outside of business. Now, the loophole that we potentially could utilize is what happens if you brand a t-shirt and you have your logo on it. That absolutely could be an advertising expense.
Gotcha.
So that's and obviously you're not going to brand all of your clothing, but you might purchase, a name tag. Name tag is definitely either advertising or office expense. But if you're going to wear, my sweater, I can't deduct it, even though it's close to my logo color. I still can't deduct it. It's just, it needs to be very specifically, you can't utilize it outside of work. So like a judge could do a judge's robe, a judicial robe, but he couldn't do the suit that he wears under it. So that, I
Perfect.
mean,
Yeah.
that type of situation.
Hmm.
There's
Okay.
the weird thing is, if you travel for business and you get your suit dry cleaned during travel, that dry cleaning counts.
Okay.
It is so weird. So keep
See,
your
these
dry
are
cleaning
all,
receipts if you're traveling,
yes,
but
yes. Well, I would definitely never dry clean for personal use. So
it's
makes sense. Yeah.
oh, I know. Like, no, I don't buy things that are dry clean only. I don't have time for that.
Yeah, yeah. Although there's a lot of agents who definitely do still wear suits, but that's the kind of, this brings me to the next topic, but that's the crazy thing in real estate is, you have some agents that might make 10,000 for the whole year, and then you can go up to, $1 million in commission for the year.
Mhm.
So at what point would it be advised to, or if at all, to go from being just filing as a sole proprietor versus creating an LLC, S corp, and paying yourself as an employee? And would there be a tax benefit to that? And when should we consider doing that?
So, sole proprietors and LLCs are taxed the same way. So it's called a pass-through entity. So what happens is you get your income, you take all your deductions, your expenses, and you're left with this bottom line. We accountants call that a net income. So your net income is what you're taxed on as a sole proprietor, or as an individual, or as a single member LLC, and that's what you're paying your income on. So from a legal standpoint, which obviously I can't talk about very much, but the limited liability company, or LLC, those LLCs are going to help protect your personal assets. So talk to a lawyer about that one. But from a tax standpoint, those are the same. But then Amber mentioned an S Corp. So as an S Corp, you can ask the IRS, you can say, hey, from a legal standpoint, I'm still an LLC, so all of that's taken care of. But IRS, would you please allow me to be taxed as an S corp? And what that means is you're treated more like a corporation than you are an individual. So think about going into an office every day, everybody gets a paycheck, which is deductible, which is one of those expensive that gets you to your net income. So as an S corp, whether it's a sole member or maybe you have, a company, a group of agents together, that salary that you have to pay yourself is reducing that net income. So that net income is still passed through to you as an individual, but if you're paying your income and you're paying your taxes on that income, then you're left with a much smaller net income than you would be. So you're still paying your Social Security taxes. You would give yourself a W-2. It's kind of weird, but you would be withholding that 15.3%, which includes your Medicare, and your Social Security taxes and your federal income taxes. So you're doing that withholding, you're doing that savings account every paycheck. And then you pay lesser, because if you think about it, if you think about tax brackets, they're in the 20s usually. 15.3 is less than 20. So that's where that benefit happens. There's also quite a few other tax benefits to being an S corp. One of those is, which very complicated, and people look at me very cross-eyed when I say it, but you as an individual can rent to your business for 14 days tax-free a year at a reasonable, rational rate. That's called the Augusta plan. Then there's the accountable plan, which you can, utilize a portion of your expenses that you pay yourself back to as an individual, which again, reduces that net income. So there's ways you can do that's very beneficial, because at the end of the day, we don't want the IRS to have more money of ours than what we want them to have. So, I mean, if we have a reasonable way to reduce that, let's do it. And what I typically tell my small business clients is, when that net income starts creeping up into the six figures, that's when we really need to start thinking about being an S corp. So you have to pay yourself a reasonable salary. Again, the IRS doesn't really define that. But as an agent, if you're paying yourself $15,000 a year, that's not reasonable. So let's get up into those six figures and pay yourself what you're worth, first of all. And that way you're not shortcutting yourself. You're making sure that you're getting what you need as an individual. You're helping your tax liability. And if you're still in flux, let's say one year you have a great year, the next year you don't. And obviously that's not based on you guys. That's really based on the market. But if you can,
Right.
if you have that steady income for a few years and you're like, all right, I'm getting close to that six figures and growing, then you probably should start thinking about that S corp. And that's definitely when you want to get a professional involved, so they can have the direct communication with the IRS that says, please, IRS, would you allow me to become an S corp? And then they can also tell you all the tips and tricks that help reduce that net income at the end of the year.
Awesome. Well, this has been great, very
So much fun talking
educational,
about
and
taxes.
yeah, money. Let's keep more of it. Did we forget anything? Is there anything that you wanted to touch on that we didn't?
I just kind of want to reiterate what I said at the beginning is just organize. If you stay organized, you're not going to leave that money on the table because you're going to be completely aware of, okay, I went out and I had a coffee with a potential client, or my mileage from that potential client call, to the house. If you just stay organized and really keep on top of it, then that's really going to help you at the end of the year. You're not going to be scrambling to find something, anything to help reduce that taxes.
Yeah. So, two morals of the story: track everything and talk to a professional. Do not try to
Yes.
do this yourself.
No.
I
It's
used to
it's a
always do
lot.
my own taxes, but that was back when I was an employee and, it was just so simple. But now that, I itemize or maybe even have to choose, is it worth itemizing or taking the standard deduction? I don't want to, I'm not the expert on any of that. So I highly recommend talking to a professional for this. And we have one right here. I'm going to put your information. I mean, all of your links will be here in the notes. And yeah, and remember, Kat can help you anywhere in the country, no matter where you are listening to this.
Absolutely. Thank you so much for having me, Amber. I appreciate it.
Yeah. Thank you. Thank you. And thanks everybody for joining, and let us know what else you want. Oh yeah, come back for part 2 and 3, because we next time we're going to be talking about capital gains tax for homeowners for when they sell their house and how to reduce that. So, all right. Thanks everybody.
Awesome. Thank you.
Bye. This podcast is sponsored by the Alchemy Group, transforming lives one agent at a time. With the Alchemy Group, you can design and create a business and a life that you love alongside the country's top agents. Join us and own a piece of your own brokerage. Text me to get started, 617-281-3333.